The silver market is much thinner. The more conservative players like the bullion banks, which are not speculators, right? They go short in the gold market in New York and they go long in London and they just profit off the spread. They're not speculating anything. Silver is more expensive in the spot market than it is in the futures market. Then you can't hedge your short positions in silver. How did I predict it? How did I foresee that? I didn't foresee it. I'm just looking at the chart of silver and I see what happened in 1980. There's going to be another pullback, but you have to be honest and sometimes and say, well, there probably is going to be. So I said there was going to be. And backwardation in silver becomes permanent and then moves into gold. And then the prices for spot keep going higher and higher and higher. And the prices for futures keep going lower and lower and lower. I think we're going to get there once we have the next banking crisis. The Fed has to cut to zero. Why should I buy gold and silver mining stocks now when gold is about to fall? But that's not going to happen this time. But this next printing round is just going to bring gold even higher. I'm holding gold and silver, for good. I'm not going to sell it. Well, I am going to sell it. There's no point in holding on to gold and silver until I'm dead. I follow mostly the open interest in the gold market. I do pay attention to open interest in the silver market, but because the silver market is much thinner, I think that the open interests are slightly less indicative for that market than gold is for precious metals in general. So if you look at open interest just means the amount of contracts that are open in the gold market. And right now it's about 400. I think the last I saw was 406,000. So usually they're between, let's say, 450 and 550,000. That's like that's the range that's been in place for 10 years. Sometimes it gets below that. Sometimes it goes above. But the last time we were at about 400,000 was like 2 or 3 times since bear market bottom in 2015 when gold was like $10.45 an ounce, $1,045. So what 400,000 signals to me is that these speculators are mostly gone from the market. Now, it doesn't mean that the volatility is over. Obviously, it's not. And in a market like this, you only need a little bit of open interest to drastically affect the price.
When open interest drops to 406,000, most traders see weakness, but it may signal something far more structural. As Rafi Farber points out here, that level hasn't been common since the 2015 bottom, near $1,045 gold. And historically, when participation thins, volatility expands because liquidity dries up. With a 10-year average range sitting between 450,000 and 550,000 contracts, we're operating below typical engagement, meaning smaller flows can swing price harder. For portfolio managers, that's not calm, it's fragility. And what Rafi Farber suggests next reframes how thin markets can fuel outsized moves.
Because the more conservative players like the bullion banks, which are not speculators, right? They go short in the gold market in New York and they go long in London and they just profit off the spread. They're not speculating anything. But they don't want to participate in this market so much because in my view, they see the backwardation in silver, I'm using that word, not how I define it, but how people generally use it. Backwardation is higher spot prices for if you want to buy actual metal than futures price if you want to contract future delivery. So because silver is more expensive in the spot market than it is in the futures market, then that means that you can't hedge your short positions in silver. And bullion banks will see that and they'll say, look, I don't want to do this right now and short in the futures market and go long in London because I don't know how long that spread is going to be positive, right? It's getting thinner and thinner and thinner, so it's more dangerous to do that even if you're hedging.
When bullion banks step back from easy spread trades, that's not routine, that's caution. As Rafi Farber explains, backwardation in silver means spot trades above futures, breaking the usual contango structure that allows safe arbitrage between New York and London. When hedging stops working, liquidity providers pull back, and thinner participation magnifies price swings, a dynamic we saw briefly during March 2020 stress. For investors, that's a plumbing issue, not a headline story. And what Rafi Farber implies next raises questions about how deep that strain really runs.
And I think that's the main reason why a lot of coin shops have shut down and they're not able to buy constitutional silver anymore from the public because they'd have to send it to a refiner, and the refiner would have to hedge that inventory in order to ensure a profit for itself, and they can't hedge because the spot price is higher than the futures price. They can't do it, so the refiners can't take it, and therefore the coin shops can't send it to the refiners, so the coin shops can't take it from the public. That's the bottleneck that's happening. So anyway, back to the open interest. If the bullion banks are reluctant in this kind of environment to make a market, that's what they're called, the market makers, to make a market in gold, and it doesn't mean that none of them are, it just means they're doing it less, then price is going to move on a small move in open interest. So the volatility is going to last a little while longer. I don't know how long, but the volatility doesn't mean that there's a huge amount of speculators in the market. There aren't.
When coin shops stop buying, it's not retail panic. It's a breakdown in hedging economics. As Rafi Farber notes, refiners rely on futures to lock margins, and when spot exceeds futures, that risk transfer collapses, freezing inventory flow from Main Street to the wholesale market. That bottleneck reduces physical liquidity, while futures open interest remains subdued, a combination that historically amplifies volatility rather than calming it. Investors holding mining stocks or ETFs should recognize this isn't speculation-driven churn, it's structural friction. And what Rafi Farber outlines next challenges the assumption that low participation equals stability.
So my thesis is that while we still might be a little bit away from a bottom in gold in terms of time, I don't think we're far away in terms of price. I don't think we're going to get much farther from where we are now for gold. I think we're at 4,900 now. I think we're going to float between, let's say, 46 and 52, where we've been bobbing up and down since the mini crash at the end of January. I don't think it's going to change much from that.
No, you did write an article just before the huge plunge in silver prices that you were predicting that, there's probably one major pullback coming before the end game. So it sounds like, I guess, first off, how did you, foresee that happening? And then second of all, what kind of time frame do you expect, or what kind of increased volatility do you still see from here? It sounds like it's not over in your view.
How did I predict it? How did I foresee that? I didn't foresee it. I'm just looking at the chart of silver, and I see what happened in 1980.
Calling for a sideways range between $4,600 and $5,200 sounds stable, but history suggests consolidation phases often precede expansion. As Rafi Farber references past analogs like 1980, sharp silver pullbacks frequently reset sentiment before larger macro-driven moves, especially when liquidity tightens. After January's mini crash, volatility compression may simply reflect positioning rather than equilibrium, particularly with Fed policy uncertainty heading into upcoming meetings. Long-term investors should separate time correction from price correction. And what Rafi Farber signals next hints that volatility may be far from finished.
I see what happened in 1918. I see what happened in 1968. And I see what happened in 2011. I was like, something like this is probably going to happen again. It doesn't take a huge amount of chachma to figure that out. It's just like you have to be able to balance yourself as a silver bug and not force yourself to constantly be cheering the prices going up, because that's the business that we're in. For better or for worse, that's what we do. We encourage people to buy, to exchange their gold and silver derivatives for actual money, and it's hard to do that when you're saying, well, there's going to be another pullback, but you have to be honest and sometimes and say, well, there probably is going to be. So I said there was going to be. I didn't know when. But it makes sense. I'll change that thesis and I'll say there's going to be no more pullbacks when I clearly see that everything is falling apart right in front of my eyes.
Market memory matters more than market emotion. As Rafi Farber reminds us, 1918, 1968, and 2011 weren't straight-line rallies. They were violent cycles with sharp retracements before exhaustion peaks. Silver fell nearly 30% in weeks during 2011 before its final surge, a pattern long-term investors often forget when momentum feels unstoppable. Discipline means expecting pullbacks even inside secular trends, especially with speculative positioning elevated. Rafi Farber is signaling that emotional bias can be more dangerous than volatility itself. And the next phase may test conviction again.
I see all the setup for it now, but people are still buying food in the supermarkets. People are still driving cars and buying gasoline. Things are still basically working. Nobody's starving to death in the streets or anything like that. And as much as we know that everything is messed up, like seriously messed up, still you wake up in the morning, you do your daily stuff, and then, you come back home, you go to sleep, you wake up the next day, it's basically the same, even though you know all this stuff is going on in the background. But eventually that's going to change, right? When it changes and backwardation in silver it becomes permanent and then moves into gold, and then the prices for spot keep going higher and higher and higher, and the prices for futures keep going lower and lower and lower relative to the spot. Then I'll say, okay, you know what? I think this backwardation is just going to keep getting worse and worse, and that's it. And I think we can batten down the hatches, and I'll sign off and nuke my channel, and maybe, I don't know.
Crises don't begin when life feels chaotic. They begin while everything still looks normal. As Rafi Farber suggests, permanent backwardation would signal structural distrust in paper pricing, something rarely sustained in modern markets. Historically, commodities revert to contango because storage and financing costs anchor futures pricing. A lasting inversion would imply severe liquidity stress. For investors, that's not about headlines. It's about system plumbing breaking beneath calm consumer behavior. Rafi Farber is implying that when spot disconnects persist, financial stability narratives could unravel fast.
And I'll say that's it, but we're not there yet. But when we get there, we'll get there quickly. And I think we're going to get there once we have the next banking crisis, and the Fed has to cut to zero, and you'll see that the Fed funds rate will be slammed to zero by Warsh or whoever's going to be in charge. Kevin, I think his name is Kevin Warsh. And the 10-year yield will not fall like it did in 2020 as sharply. And then the Fed will start to panic and announce that it's buying a whole bunch of 10-year yields to try to push the yield down on those. And then that'll be it. At that point, I'll say, look, guys, this is it. This is your last chance. Do it now or forever hold your dollars. You can frame them on the wall or use them for firewood or whatever. Or, hold your Bitcoin, and I don't know what you could do with that. So we're close because there's only one more step to that. I just don't know when it's going to happen, but I know that it's the next step.
The real trigger isn't inflation. It's a policy panic. As Rafi Farber outlines, a forced return to zero rates combined with yield curve resistance would mirror crisis playbooks from 2008 and March 2020, when emergency cuts preceded aggressive bond buying. If the 10-year yield refuses to drop while the Fed eases, that signals inflationary pressure embedded in the bond market itself. For equity investors, that mix historically compresses valuations while boosting hard assets. Rafi Farber is pointing to policy exhaustion as the real catalyst.
And I remember I was just walking into my house and thinking, like, this could happen at any time now. We'll hear of a bank falling over the weekend or something. I mean, that's how the March 2023 regional banking crisis happened. All of a sudden, I woke up in the morning and I saw all these messages saying, Silicon Valley Bank fell. I'm like, what is Silicon Valley Bank? And then I looked at it. I'm like, well, okay, well, something's happening. Well, that's what it's going to be this time. Some bank is going to signal some SOS distress signal, and then other banks are going to say, and then we'll be, okay, well, this is it, guys. It could be any time, but it's going to happen. And when it happens, I'll probably call, that's it, grab your stacks, is your last chance. I'm not going to put all of my assets outside of the system or all of them into the system. Like, I don't do everything anywhere.
Banking stress rarely trends on social media before it erupts. As Rafi Farber recalls, Silicon Valley Bank collapsed in March 2023 almost overnight, despite weeks of rising bond losses on bank balance sheets. Over $40 billion was reportedly withdrawn in a single day. A reminder that liquidity risk accelerates non-linearly. Diversification across custody structures matters more than dramatic positioning shifts. Rafi Farber is emphasizing preparedness over panic, and that's a message long-term investors ignore at their own risk.
I'll put some in bullion, a very small amount that I have with me, just for emergencies, nothing big. And the rest I'll have somewhere, that I don't have immediate access to, but I don't have to worry about it getting stolen. And people say, oh, there's the great taking, and you don't really own it because the brokerages, they hypothecate or rehypothecate or reissue-hypothecate or whatever they say they do, and they probably do. So you can argue that, oh, your mining stocks aren't going to be worth anything. Maybe they won't be. I can't really. I'm not going to think in those directions. Like, whatever happens to them happens to them, and if I lose them all, well, I have bullion, so fine, whatever. But if we're going to just put all that aside, then I would say that I think what's happening now in mining stocks is that a lot of people who have seen the past cycles in gold and silver, they say, oh, well, yeah, well, they go up, and then the Fed cuts, and then everyone thinks they go up, but they go down because credit's reinflating, the purchasing power of credit's reinflating, and so that's probably what's going to happen this time.
The quiet admission here is that counterparty risk isn't theoretical. It's baked into the system. Rafi Farber hints at rehypothecation risk, and he's right to acknowledge it, because brokerage assets legally can be pledged multiple times in stress events, something exposed during 2008, and again in the 2020 liquidity crunch. But the leap from structural risk to mining stocks might be worthless skips a key distinction. Equity ownership survives cycles unless credit markets freeze entirely. Historically, after Fed cuts, 2001, 2008, 2019, miners initially lagged, but then outperformed once real rates fell decisively. The real question isn't fear of a great taking. It's timing liquidity versus policy pivots. And what he implies next forces investors to confront whether this cycle will truly mirror the last.
So why should I buy gold and silver mining stocks now when gold is about to fall? This has happened before. But it's not going to happen this time because I believe that Daniel Oliver is right of Mermacan Capital, and this next printing round is just going to bring gold even higher. And the importance of mining stocks, if you believe that you'll retain ownership of them through whatever great taking might happen, is that they will be able to pay you in real money dividends in some form. Whether you'll get them through the Endgame process or not, I don't know. But these are real capital that produce real money, and other companies won't be able to pay you dividends, but they will, and a lot of them will honor that. Some of them might not, but put your assets in different things that might pan out, and gold and silver stocks might pan out. They might not, and if not, hold some bullion. Okay, there's no problem in hedging your bets here in that way.
The market rarely rewards certainty, especially when it's framed as this time is different. Rafi Farber leans on Daniel Oliver's thesis that renewed monetary printing will push gold higher. But history shows miners respond more to real interest rates than headline liquidity. In 2020, gold surged 25%, while many miners underperformed due to cost inflation and operational risk. Dividends sound attractive, yet only a handful of major producers consistently generate free cash flow, strong enough to sustain payouts through downturns. Diversification makes sense, but assuming guaranteed real money income ignores geopolitical, tax, and jurisdictional risk embedded in mining equities. And the next argument shifts from stocks to the very definition of money itself.
Let's just unify the language and make this clearer. Selling is just giving up one thing for another thing. If you spend dollars, you're selling dollars. And the definition of money is the most liquid commodity that exists in an economy. The reason that we call the dollar money is because it stands in for the most liquid commodity, which is gold and silver. And now there's a whole bunch of inflation on top of that. But essentially, when you get down to the nature of what a dollar is, it's a dollar derivative. It's a gold derivative. It's a ticket for a certain amount of dollars. And still technically, it's a ticket for $42.22 an ounce of gold. That's what it is. Everything else is inflation on top of that core, right? Dollar isn't a fiat currency in the sense that it's all nothing. It's a little bit of gold with a huge air bubble of inflation on top of it. So when I say I'm holding gold and silver for for good, and I'm not going to I'm not going to sell it. Well, I am going to sell it.
This is where philosophy meets financial reality. And the distinction matters. Rafi Farber frames the dollar as a gold derivative. But since 1971, the US dollar has not been legally redeemable for gold, making it structurally fiat under modern monetary policy. The $420 reference traces back to historical statutory gold values, yet market gold trades multiples above that because price discovery floats freely. Liquidity today is driven by treasury markets exceeding $25 trillion outstanding, not gold convertibility. Language can clarify thinking, but investors must separate metaphor from legal and monetary structure. And what he proposes next redefines selling in a way that challenges traditional portfolio logic.
There's no point in holding on to gold and silver until I'm dead. And what's the point of that? It's, so what? I may as well hold up the dollars until I'm dead, whether I have a stack of paper in somewhere hidden, or I have a stack of metal somewhere. What's the difference if I don't use it? It doesn't make a difference. So I do plan to sell my gold and silver, except I won't sell it for dollars. That doesn't make any sense. I plan to sell it for stuff. And then take that stuff and, I don't know, build an empire. I'm not going to build an empire. I'm not an empire builder, but whatever. I have certain values, so I'm going to spend my resources in trying to get those values realized in the world. And I think this is my chance to do it. So that's what I'm going to do. I'm going to spend. So back 1 second to the definition of money. Money is the most liquid commodity. The most liquid commodity in an economy means the commodity that people want to buy and sell the most of at the same time has the most liquidity, the most buy and sell orders simultaneously. So when I spend gold and silver, I'm selling it. I'm going to sell it, except instead of for derivatives of that same commodity, I'm going to sell it for other things, assets, real stuff.
Assets only matter when they convert into real-world outcomes. Rafi Farber argues for exchanging gold directly for tangible assets, bypassing dollars, and philosophically that's consistent. Money is a medium, not the end goal. But in practice, transaction systems, tax law, and pricing benchmarks are dollar-denominated, meaning liquidity still flows through fiat rails whether we like it or not. Historically, during inflationary spikes, 1970s, post-2020 stimulus, hard assets outperformed cash, but conversion timing determined wealth outcomes. The strategy isn't hoarding metal forever. It's knowing when purchasing power peaks relative to real assets. And the timing of that conversion is where fortunes are either preserved or quietly eroded.